Listen up, because what I'm about to share with you is going to completely reshape how you view the silver market. Yesterday, banking institutions pushed silver's paper price down to 61.96, and they're hoping you'll buy into their story that the rally is finished. They want you thinking silver was just another speculative bubble that finally burst. But here's what they're not telling you, and this omission is so significant that it changes everything. While everyone was watching the COMEX ticker movements yesterday, while algorithms were systematically selling paper contracts across New York exchanges, something groundbreaking happened in South Korea, something that makes the current silver price completely irrelevant. Samsung SDI, one of the world's largest battery manufacturers, just quietly released specifications for their revolutionary solid-state production line. The mainstream press is calling it a battery breakthrough, talking about 900-mile range with 9-minute charging. However, they're completely missing the most critical detail. Wall Street hasn't factored this in. Mining companies haven't adjusted forecasts. This detail makes the existing 1.1 billion ounce deficit look trivial. The key component in Samsung's new battery isn't lithium. It's not cobalt or nickel either. It's silver, and we're not discussing trace amounts. This represents a massive structural shift in silver consumption per vehicle. This technology is fundamentally redefining silver from a precious metal into a strategic energy commodity. I'm going to reveal the supply chain crisis Samsung just triggered. I'll explain the chemistry behind the silver carbon anode. I'm going to run calculations that prove there isn't enough silver on Earth to electrify the vehicle fleet using this technology. And I'll show you why Friday's drop to $62 wasn't a crash, but rather the final opportunity to acquire silver before the auto industry realizes their miscalculation. Banking institutions are playing a paper game. Samsung is operating within physics constraints. Physics always wins. This is the silver carbon revolution story. To understand why this represents a critical event for silver supply, you need some basic chemistry knowledge. Don't worry, I'll keep it straightforward. For 3 decades, the world has run on lithium-ion batteries. Your smartphone, laptop, even the Tesla in your driveway all use liquid electrolyte lithium-ion batteries. They perform well, but they have a fatal flaw called the Dendrite problem. When you charge a lithium battery rapidly or cycle it too many times, lithium ions form microscopic needle-like crystals called dendrites. These structures grow like jagged roots throughout the battery interior. Eventually, they pierce the separator between the anode and cathode. When that happens, you get a short circuit leading to thermal runaway and fire. This fundamental limitation explains why electric vehicles require 45 minutes for charging. You must charge slowly to prevent dendrite formation. This is why they occasionally catch fire and why range diminishes in winter. The holy grail has always been the solid-state battery offering no liquid components, zero fire risk, instant charging, and double the range. Every major manufacturer from Toyota to Volkswagen has promised this for a decade, yet all encountered failure. Why? Because they couldn't prevent dendrite formation on the anode. Graphite anodes proved ineffective. Silicon anodes expanded too much. Pure lithium metal anodes showed too much instability. Then Samsung SDI researchers discovered the breakthrough. They identified one specific element that, when applied as a nanocomposite layer, completely eliminated the problem. This material allowed lithium ions to migrate freely while stopping dendrites completely. It demonstrated perfect stability and excellent conductivity. That element is silver, specifically as a silver carbon nanocomposite layer. This isn't theoretical anymore. This is published science. Samsung's prototype cells incorporate a thin layer combining silver with carbon to regulate lithium deposition. The silver functions as a host matrix for lithium ions, dissolving them uniformly and preventing spike formation. This enables batteries to become smaller, lighter, faster, and dramatically safer. But there's a significant catch that changes everything. To manufacture this battery successfully, you need substantial silver quantities. We're not discussing micrograms. We're talking grams per battery. For the first time in industrial history, silver isn't simply being used for conductivity. It's employed as an active material directly participating in the electrochemical storage process. Silver is becoming integrated into the battery's fundamental structure. And the automotive industry is preparing to scale this to millions of vehicles annually. You might think using some silver isn't particularly significant since vehicles already contain silver components. Let me provide context. Currently, a standard combustion vehicle uses approximately 15 to 20 grams of silver distributed across window switches, seat motors, defrosters, and the electronic control unit. An electric vehicle uses substantially more, around 30 to 50 grams, found in inverters, battery management systems, and high-voltage cables. This EV increase is already creating market strain and contributing to our existing 1.1 billion ounce deficit. But solid-state battery technology transforms the equation entirely. We're no longer discussing small switch components. We're discussing coating the anode surface of every cell within a 1,000-pound battery pack. Early estimates from Samsung's technical papers suggest silver loading requirements could range from 5 to 10 grams per kilogram of anode material. Some aggressive projections suggest quantities could reach half a kilogram to 1 full kilogram per vehicle for high-performance, long-range packs. Let's approach this conservatively. Assume this technology adds just 50 grams per vehicle. That brings total silver content per electric vehicle to roughly 100 grams. Global automotive production stands at 90 million vehicles annually. If merely 10% transition to solid-state batteries, we're discussing 9 million cars. 9 million cars times 100 grams equals 900 million grams, translating to roughly 29 million ounces of new annual demand. That might sound manageable, but that's only 10% adoption with conservative estimates. What if we reach 50% adoption? What if actual silver loading turns out to be 200 grams per vehicle? If Toyota, Samsung, and Volkswagen hit their stated targets of mass-producing solid-state EVs by 2027 through 2028, we could witness automotive silver demand exploding from 90 million ounces annually to 200 or even 300 million ounces yearly. Where does that additional 200 million ounces originate? Does it come from COMEX warehouse inventories holding only 30 million ounces in registered stock? Does it come from mining companies when global production has plateaued at 830 million ounces annually? This single technology could consume 25 to 35% of entire global mines' supply exclusively for automotive batteries. That leaves nothing available for solar panels, electronics, jewelry, or individual investors. Samsung has just confirmed they're constructing the pilot production line. The timeline has accelerated beyond initial projections. This isn't a distant future scenario. This is happening right now. While banking institutions were pushing the price to 150 on Friday, Samsung's procurement officers were likely executing long-term supply contracts with mining companies. They understand the mathematics. They recognize that without securing adequate supplies, their billion-dollar manufacturing facilities become worthless. This transformation represents a fundamental shift in demand dynamics. Historically, silver functioned as an industrial seasoning. You used minimal amounts on circuit boards and tiny quantities in switches. Because quantities were so small, price fluctuation didn't matter significantly. If silver increased from $20 to $100 per ounce, iPhone manufacturing costs only rose 50 cents. Apple didn't care about that marginal increase. With solid-state batteries, silver becomes structural. It transforms into a major cost component. If a battery pack requires 500 grams of silver at $60 per ounce, that represents $1,000 of silver in every vehicle. At $100 per ounce, that cost escalates to $1,600. This concerns automotive manufacturers operating on thin profit margins. A $600 cost increase per vehicle destroys their profit structure. So what's their strategic response? They'll attempt to reduce silver content through engineering. They'll try to engineer it out. They'll experiment with silver-coated carbon alternatives instead of pure silver powder. But here's the fundamental problem. Chemistry is remarkably stubborn. You cannot cheat electron behavior. If you reduce silver content, dendrite problems resurface. If dendrites return, vehicles become fire hazards. Would you purchase a vehicle knowing it had significant fire risk? Obviously not. Samsung understands this. Toyota understands this. They cannot reduce silver without sacrificing safety, so they're trapped. They've become constrained by periodic table properties. This makes demand completely inelastic. Two massive global industries, energy and transportation, are pivoting simultaneously toward technologies requiring massive silver quantities, and they're colliding with a supply chain that's been starved of investment capital for a decade. Friday's price decline to 150 is remarkable when viewed in this context. We're looking at a future where silver becomes as economically critical as petroleum. Imagine if the world faced oil shortages and prices simultaneously dropped to $2 per barrel. Would you panic sell, or would you fill every tank you owned? Why aren't you hearing about this on financial networks? Why is Bloomberg discussing lithium oversupply while completely overlooking the silver supply situation? Because the mainstream narrative hasn't caught up with laboratory reality yet. Wall Street analysts are examining outdated spreadsheets from 2020. They assume electric vehicles simply equal lithium plus nickel in their models. They treat silver as a legacy metal primarily used in mirrors and silverware. They're not reading Samsung SDI's technical white papers. They're not examining patent filings from QuantumScape and Toyota. If they performed that research, they'd see silver appearing repeatedly throughout documentation. This information gap represents your competitive advantage. Right now, the market is fundamentally mispricing silver because it assumes demand growth will remain linear at approximately 2% annually. The market doesn't recognize the step function change that solid-state batteries represent. The exact pattern occurred with palladium during the early 2000s. Automotive companies transitioned to palladium for catalytic converters. Nobody paid attention initially. Then demand suddenly exploded. Palladium prices rocketed from $200 to $3,000 per ounce. Financial analysts were 10 years behind. We're witnessing the identical setup with silver now. The supply crisis has already developed within research laboratories. The shockwave simply hasn't reached price charts yet, but it's approaching. When Samsung officially launches the first mass market vehicle with this battery, when they publish complete specifications and the world realizes there are 20 ounces of silver in a single luxury sedan, the urgent buying won't originate from retail forums. It will come from Ford, General Motors and BMW headquarters, and they won't be purchasing at 60, 150. So we've established the technological reality. The silver carbon anode is genuine, it's technologically superior, and it's coming to market soon. But now we must address the critical question nobody wants to confront. Is there actually enough silver if every automotive company transitions to this technology? If solar manufacturing continues expanding, if investment demand persists, do supply numbers actually work mathematically? Let me show you the calculations that the International Energy Agency hasn't published. We're going to examine why recycling won't rescue us and explain why Friday's price of 60, 150 is mathematically unsustainable long term. In a world where automobiles consume silver at industrial scale, this is where theory meets physical reality. Let's start with today's baseline before the Samsung crisis fully develops. Total global mine supply stands at 830 million ounces annually. Recycling adds approximately 180 million ounces yearly. Total combined supply equals 1.01 billion ounces. Now examine demand before solid-state batteries achieve penetration. Industrial demand, including solar and electronics, consumes 600 million ounces. Jewelry and silverware requires 200 million ounces. Investment demand through coins and bars takes 250 million ounces. We're already operating in deficit. We're burning approximately 50 to 100 million ounces of reserves yearly, just maintaining current operations. Now introduce the Samsung scenario. Assume moderate adoption where by 2028, 20% of new electric vehicles use this technology with conservative silver loading of 50 grams per vehicle. Global car production totals 90 million units annually. Electric vehicle market share reaches 40%, equaling 36 million electric vehicles. 20% using solid-state batteries equals 7.2 million cars. 7.2 million cars times 1.6 ounces equals 11.5 million ounces of new demand. That creates stress but doesn't completely break the system. But that assumes small, efficient vehicles. What about a Ford F-150 Lightning or Cybertruck? Those battery packs are massive. They don't use 50 grams. They might require 500 grams each. If average silver loading across the fleet approaches 200 grams and adoption reaches 50% of electric vehicles, let's recalculate. 18 million cars times 6.4 ounces equals 115 million ounces of additional annual demand. 115 million ounces exceeds Peru's entire annual production. That's equivalent to another complete solar panel industry materializing overnight. Where does that originate? The market is already in deficit. Warehouse vaults are depleted. There are only two possible sources. Price increases so dramatically that consumers stop purchasing jewelry and silverware, or prices rise so high that individual investors sell their holdings to Samsung directly. This is the extinction equation. Total supply becomes less than solar plus electronics plus solid-state batteries combined. We're not even accounting for investment demand. Industrial demand alone threatens to consume 100% of global mine supply. If that materializes, silver ceases functioning as a monetary metal accessible to the public. It transforms into a critical strategic material reserved exclusively for industrial applications. But skeptics claim we'll simply recycle existing silver. We'll extract silver from old vehicles. This is the recycling misconception, and it's problematic because it provides false security about supply constraints. Here's recycling reality. Gold gets recycled at nearly 90% efficiency because it's highly concentrated. Silver gets recycled at less than 20% efficiency because of extreme dispersion across applications. Silver is distributed in microscopic quantities across billions of devices. There's 0.1 grams in your smartphone, 0.5 grams in your laptop. There's thin film coating in solar panels. It costs more energy and money to extract that dispersed silver than the silver itself is worth. So it gets sent to landfills. We're literally burying billions of ounces back into Earth in a form that's economically impossible to mine profitably. Now consider solid-state battery recycling timeline. Yes, it contains more concentrated silver, but you don't recycle a car battery next year. You recycle it in 15 years. Silver incorporated into a Samsung battery manufactured in 2026 remains locked away until 2041. It's completely removed from available supply for an entire generation. The recycling wave everyone hopes will rescue us won't arrive in time to prevent the shortage developing throughout the 20s. The deficit is structural. Consumption is destructive. Sequestration is long-term. This means the only viable solution is dramatically increased mining production. But can we simply dig more? If silver reaches $100, surely miners will flood the market with supply, right? Wrong. This is the geological wall we're facing. You cannot instantly create a silver mine. It requires roughly 10 to 15 years from initial discovery to full production. If we discovered a massive deposit today, it wouldn't produce a single ounce until 2035. But Samsung needs silver now. Tesla needs silver now, and existing mines are declining, or grade quality has collapsed dramatically. In 2005, a quality mine produced 15 ounces per ton. Today, a quality mine produces 4 ounces per ton. We must excavate 4 times more rock to obtain the same silver quantity. That requires more diesel fuel, more water resources, more labor. It's becoming exponentially harder and more expensive to mine. And there are political complications. Mexico produces 25% of global supply. The Mexican government has stopped issuing new open pit mining permits. Peru faces constant strikes. Russia faces sanctions. So precisely when silver carbon anode technology demands 100 million new ounces, global mining supply is actually threatening to shrink. This is a pincer movement. Demand is exploding. Supply is collapsing. And the inventory buffer has been exhausted. There's no relief valve. There's no elasticity. The only variable that can adjust is price. This leads to what I call the electric vehicle paradox. Governments worldwide have mandated the end of internal combustion engines. They've legally forced the transition to electric vehicles. They're subsidizing battery factory construction, but they forgot to check periodic table constraints. If silver reaches $200 per ounce, solid-state battery pack costs skyrocket. Electric vehicles become unaffordable for average consumers, and the transition stalls. But governments cannot allow the transition to stall. They've staked their political reputations on achieving net zero emissions. So what will they do? They'll subsidize silver directly, or they'll prioritize existing supplies. This is where it becomes real. If General Motors tells Washington they cannot build legally mandated cars because they cannot obtain sufficient silver, Washington doesn't say forget the cars. Washington says we will obtain the silver through necessary means. They'll declare silver a critical strategic material under national security provisions. They'll prioritize industrial allocation over retail investment access. They might restrict public sales of silver coins to divert metal toward battery factory requirements. This is the concerning scenario for investors who haven't accumulated positions yet. You won't simply be competing with high prices. You'll be competing directly with government priorities. Samsung isn't merely a company in South Korea. It represents significant economic importance. The South Korean government will ensure Samsung has silver supplies. The United States government will do the same for Tesla. The silver carbon anode makes silver a matter of national security, and national security concerns consistently take precedence. So we have validated technology, we have completed mathematics. The conclusion is undeniable. We face a structural shortage. But how do you position yourself? Friday's decline to 60-150 has frightened many investors out of positions. But if you understand the Samsung scenario, you realize 60-150 represents a pricing error. Let me give you the strategic approach. I'll show you which mining stocks are best positioned for this new demand wave. I'll explain why collectible coins might actually be problematic, and I'll provide the exit strategy for when this situation reaches peak intensity. The technology is real. The shortage is real. Friday's decline doesn't reflect reality. Don't let short-term movements shake your conviction. The revolution is just starting. You now possess information that 99% of Wall Street is overlooking. You know the solid-state battery revolution requires a silver carbon anode. You know this single technology could consume 115 million ounces of new silver annually. And you know the geological wall means mines cannot expand fast enough to meet demand. So here we are on Saturday, December 13th. Silver closed yesterday at 60-150. The market appears fearful. Retail investors seem worried. But you remain calm because you recognize this price movement is a temporary mispricing before the Samsung scenario reality hits the market. But knowledge without action is useless. How do you position yourself? Do you just buy coins? Do you buy mining stocks? Do you buy exchange-traded funds? I'm going to give you the strategic playbook. I'll expose the collectible coin situation during an industrial squeeze. And I'll show you why the unhedged miner is the only stock worth owning right now. The auto industry is about to urgently acquire supplies. You need to position ahead of them. First is physical metal. This is your insurance policy. This is your wealth preservation. But in an industrial squeeze, the rules change completely. For years, dealers have promoted collectible coins, limited editions themed silver. They told you these hold value better. And in a normal market, maybe they do. But we're not in a normal market. We're entering an industrial vacuum. When Samsung needs silver for battery production, they don't care about artwork or collectability. They care about one thing only, the atomic silver content. They need raw silver to melt down into nano powder for anode production. This means in a true shortage, the premium on collectibles collapses relative to spot price. Why? Because industrial buyers set the floor price. If spot goes to $100, the melt value of your coin is $100. But nobody's paying you $150 for collectability when the world needs the metal itself. The strategy is simple. Stop paying for artwork. Start paying for weight. In the Samsung scenario, ounces matter most. A 100-ounce industrial bar is the superior asset. Why? Lower premium means you get more silver for your dollar today. Liquidity improves because if you need to sell to an industrial buyer or refiner, they want bars. Density makes storage easier because it's simpler to store 1,000 ounces in bars than 1,000 ounces in tubes of coins. If you're buying right now at 60-150, ignore fancy collectible products. Purchase the cheapest, most recognizable government or corporate bullion you can find. Maples Eagles, 100-ounce bars, 10-ounce bars. Your goal is accumulating the maximum number of grams before Samsung clears the shelf. Second is mining stocks. This is where significant wealth gets created if you pick the right companies. But there's a massive consideration called the hedging book. Imagine a mining company that last year when silver was $25 got scared. They wanted to guarantee profits, So they signed contracts to sell 50% of their production at $30 for the next 3 years. Today, silver is $61.50. That company is selling their silver for $30. The bank keeps the extra $31.50. Their stock will barely move. They missed the opportunity completely. Now imagine a different company. They believed in the shortage thesis. They refused to hedge. They sell every single ounce at spot price. Today, they sell at $61.50. If silver goes to $100, they sell at $100. This creates operating leverage. If their mining cost is $20, at $30 silver, they make $10 profit. At $100 silver, they make $80 profit. Price went up 3 times. Profit went up 8 times. Their stock price will likely go up 10 or 20 times. The strategy is you must audit the miners you own. Go to their quarterly reports. Look for the section on hedging and derivatives. If you see forward sales contracts, reconsider. You want 100% unhedged exposure, and you want primary silver miners. Most silver comes as a byproduct of lead or zinc mining. Those companies don't care significantly about silver prices. It's just a bonus. You want a company that depends entirely on silver. The Samsung scenario creates competition for these companies. Battery makers might start buying equity in miners to secure supply. If Samsung buys 10% of a junior miner, that stock could increase dramatically overnight. Third is geography. This is critical for the battery metal narrative. The United States government and European Union have passed laws requiring battery materials to be sourced from friendly nations. This is to qualify for electric vehicle tax credits. If a car company buys silver from certain countries, no tax credit. If they buy from a mine in Nevada or Ontario, significant tax credit. This creates a 2-tier market for silver miners. Clean supply versus restricted supply. Clean supply will trade at a premium. Samsung and Tesla will pay more for silver from a secure jurisdiction because it keeps their supply chain compliant. The risk in Latin America is significant. Mexico and Peru are giants of silver production, but as prices rise to $100, the temptation for their governments to intervene becomes substantial. We're already seeing labor strikes and operational challenges in these regions. The strategy is to tilt your portfolio toward Tier 1 jurisdictions. Canada, United States, Australia. These countries have stable legal frameworks and critically they're strategic allies for the battery supply chain. A mine in Idaho is worth significantly more to Tesla than a mine in Bolivia, even if the ore grade is identical, because the Idaho mine is secure. If you own mining stocks, check the map carefully. If 100% of their assets are in countries with history of operational challenges, you're holding elevated risk. Finally, let's discuss the exit strategy. You do need to rotate out of the battery trade eventually. Technology moves fast. Right now, the silver carbon anode is the winner. It will drive the market for the next 5 to 10 years. But in 2035, maybe they invent a graphene anode that uses no silver. Maybe they invent a sodium battery that replaces lithium-ion completely. Commodity cycles driven by technology usually last 7 to 10 years. Think of uranium in the 2000s. Think of cobalt in 2017. We're at year 0 of the silver battery cycle. You have a runway. The supply constraint is just starting. Friday's price of $61.50 is the starting line. But you must stay vigilant. If you see headlines in 5 years saying Toyota invents silver, free solid-state battery, that's your signal. That's when the structural deficit might ease. But for the next decade, the mathematics is locked in. Factories are being built today designed for silver. They cannot switch gears for at least 2 product cycles. So for the foreseeable future, the Samsung demand is the floor under the silver price. The strategy is ride the adoption curve, accumulate now, hold through the expansion phase, and look to swap into land or assets when headlines become extremely optimistic. Don't marry the trade forever. Marry the macro understanding. Date the specific technology, so you have the playbook. Physical bars prioritizing weight over artwork. Unhedged miners for leverage. Secure jurisdictions for stability. But there's one immediate consideration. We're currently in the weekend gap. The price is frozen at $61.50. But the news about Samsung, the news about the operational challenges at refineries, the news about the market dynamics, it's all circulating right now. When Asian markets open tomorrow night, we're going to see the market respond to Friday's movement. Will they accept the lower price, or will they push it back towards 64? Let me give you my specific prediction for the Sunday night open. I'm going to explain the Shanghai arbitrage that influences price movement. And I'm going to leave you with a final message about the psychological challenges you'll face next week. We've arrived at the conclusion. If you've been with me through this entire analysis, you now understand the full scope of the silver situation. You understand the technology. You understand the mathematics. You understand the strategy. Now we stand at the beginning of a new week. It's Saturday, December 13th. The markets are closed. The price is frozen at $64.50, down from highs but still holding the breakout structure. This weekend silence is deceptive. While Western exchanges are closed, information is traveling. Engineers in South Korea are running calculations. Procurement officers in Germany are updating their spreadsheets. Sovereign wealth funds in the Middle East are reading the same reports I just showed you. The paper movement on Friday gave the world a discount opportunity, but that opportunity expires on Sunday night at 6 p.m. Eastern Time. Let me walk you through the Sunday night open. I'm going to explain the Shanghai Arbitrage, the mechanism that will likely influence price movement, and I'm going to leave you with a final thought about the psychological challenges you're about to face. When the market opens Sunday evening, all attention will be on one number, the Shanghai Gold Exchange Premium. The Shanghai Gold Exchange is the physical heartbeat of the Asian market. Unlike the COMEX in New York, which is primarily a paper market, the SGE is a physical delivery market. If you buy on the SGE, you're usually taking the metal. Right now, there's a significant disconnect. On Friday, the COMEX pushed the price to 61.50. But in China, the physical premium is expanding due to solar demand and the new battery technology news. Silver on the street in Shanghai is trading closer to $66 or $67. Do you see the opportunity? If you're a global trader, you see silver for sale in New York for $61.50. You see silver bid in Shanghai for $67. That's a risk-free profit of $5.50 per ounce. What do? You buy New York and sell Shanghai. This is called arbitrage. And it's the force that prevents manipulation because to capture that profit, traders have to buy the COMEX contracts. Massive buying pressure hits the COMEX to close the gap. On Sunday night, I predict we'll see this arbitrage execute aggressively. Asian markets know about the Samsung battery. They're closer to the supply chain. They see the factories being built. They view the Western price movement as an opportunity. So here's the scenario for the open. 6 p.m. Eastern Time, the Globex market opens the gap. Asian algorithms detect the price disparity instantly. The bid floods the market with buy orders to acquire the cheaper 61.50 silver. The result is the price gaps up. It might jump instantly to $63 or $64. If this happens, Friday's movement is negated instantly. The institutions who went short on Friday will be underwater by Sunday evening. This sets the stage for continued upward pressure on Monday morning. The Shanghai Arbitrage is the policeman of the market. It prevents the West from suppressing the price too far below reality. And with the Samsung news spreading, that reality just got significantly more expensive. Now I need to prepare you for the mental challenge ahead. Next week is going to be intense. Not necessarily for the price, but for your emotions. Market participants know they're in a challenging position. They know the Samsung narrative is taking hold. They know the vaults are depleted. So their only remaining tool is volatility. They will try to shake you out. You'll see days where silver is up $3. You'll see days where silver is down $3. They want to induce stress. They want you so concerned watching the chart that you hit the sell button just to get relief. Do not fall for it. Remember the Samsung scenario. Does a $3 price movement change the chemistry of a solid-state battery? No. Does a margin adjustment change the fact that Samsung needs 100 million ounces? No. Does a concerning headline put silver back into the ground? No. The fundamentals are inelastic. The price volatility is noise. You have to detach yourself from the daily ticker. If you're checking the price every 5 minutes, you're playing their game. You're letting them influence your decisions. Instead, look at the premiums. If spot drops to $60 but the dealer is still charging $80, the drop doesn't reflect reality. Look at the inventory. If spot drops but the out-of-stock notices stay up, the drop doesn't reflect reality. The paper price is going to be used as a tool against you, but the physical reality is your protection. Banking institutions push the paper price down to 61.96. They want you believing the rally has ended. They want you thinking silver was just another speculative situation that concluded. But they're not telling you the full story. While you were watching the COMEX ticker yesterday, while algorithms were selling paper contracts in New York, something groundbreaking happened in South Korea that makes the price of silver completely irrelevant. Something happened that fundamentally changes the chemistry of the global energy transition. Samsung SDI just quietly confirmed specifications for their new solid-state production line. The media is calling it a battery breakthrough with 900-mile range and 9-minute charging. But they're missing the single most important detail. The detail that Wall Street hasn't priced in. The detail that mining companies haven't prepared for. The detail that makes 1.1 billion ounces of deficit look like a rounding error. The secret ingredient in Samsung's new battery isn't lithium. It isn't cobalt. It isn't nickel. It is silver, and not just a trace amount. We're talking about a massive structural increase in silver consumption per vehicle. We're talking about a technology that moves silver from being a precious metal to a strategic energy metal. The Samsung development has occurred in research laboratories. The impact hits Monday. The Samsung era is here, and the revolution has only just begun.